Good morning and welcome to today's 5 with Fitz. What a day we've got on our hands as I sit down and record this. You know, that brings up an interesting point. I hate to say I told you so, but in this case, I actually did. Dozens of times. The markets will be gone like a shot, I've said, when China comes to the table. Now, I've also told you emphatically that anybody who went to the sidelines or who gave in to their emotions, and it was scary, would have an epic problem on their hands getting back in. Now, to be clear, I am not telling you this to brag. That's not my style. I could have easily been wrong. This is a very, very tough business, and it's always humbling to be spot on with big moves like this one, and again at that. What's really important is what's next, and that's actually the interesting and potentially very profitable part too. It's FOMO, fear of missing out. Now, every naysayer, doomsayer, and party pooper now has to figure out how to get back on board or come to terms with the fact that they're getting left behind again. And for everybody else who's on board and who continued to buy in, as I repeatedly suggested, that's awesome because there's a good case you're going to be sitting in Fat City today. So anyway, here's my playbook. Does this rally have legs? What do I make of gold and which stock to buy? This super savvy Stuart Varney had 3 very important questions for me ahead of this morning's opening bell. Does the rally have legs? What does it mean for gold? And which stock to buy? Now, here's the interesting part and what you really want to think about is what happens today could be child's play compared to what happens next. As for gold in the stock, well, you're just going to have to watch that video elsewhere on my channel. The answers might surprise you, and I hope you enjoy it either way. Number 2, gold could fall by 50%. Yeah, very simple story here. One that is undoubtedly going to catch millions of hardworking folks who piled into it by surprise. I think gold could fall by 50% in the next 12 to 24 months. In fact, gold's in for a train wreck. I said very specifically on April 14th in the One Bar Ahead weekly update. I also noted similar caution right here in the 5 with Fitz on March 14th. I don't know what it is about the 14th, but this isn't rocket science. And those things are still true today. There are still scores of reasons why the shine could come off. A Fed rate cut, real growth, peace potential in Russia, Ukraine, Chinese tariffs, ceasefire in India, Pakistan. And that's just the stuff for starters. The smart money never waits for permission. It moves before the headlines hit. That's why the best trades and investments are already in motion and in keeping with Keith's rule of the back page, which has just become stories for the front page. By the way, and not for nothing, but the OBA family has once again had a head start on all this, thanks to a proprietary indicator I developed called the BBSI, the Bull Bear State Indicator. That's a fancy name, but the important thing is it flashed go several weeks ago. Now, whether you're a One Bar Ahead reader, an OBAer, or you're reading along, hopefully you've got analysis you trust too. And I say that because there is no excuse in today's day and age for getting caught offsides again, or at least that's my 2 cents. Number 3. Walgreens is still rearranging deck pills on the Titanic. Now, Wall Street is proudly rolling out prescription filling robots like it just invented the wheel. The company claims that its shiny new micro-fulfillment centers, boy, that's a mouthful, now process 16 million prescriptions a month and have saved $500 million by trimming inventory and freeing up pharmacists for higher value work. Now, if only they could do the same thing with insurance companies, but I digress. Anyway, cool beans, here's the thing. You don't need robots when the real prescription is a new business model. That's what Walgreens needs. I've long flagged the company, Walgreens, as a potential portfolio killer, and the numbers suggest I might have been onto something. Walgreens has flushed minus 64.9% of investor capital over the past 5 years. My personal fave and a competitor, meanwhile, is plus 153.46, and the S&P, which is a totally conservative choice, is plus 93.18% over the same time frame. The point I want to make is this. If you're going to fall for something, fall for profits and returns, not turnaround hype. I'll pass on Walgreens, Boots, and WBA. Thank you very much. How about you? Anyway, number 4. Crude oil isn't so crude after all. Imagine that. Crude oil's been trading recently like the world's heading into a deep recession or that oil's somehow going to drop off the face of the earth. But now that narrative is cracking. More specifically, I maintain it was wrong in the first place. The naysayers, again, here's that group of people, the naysayers, pontificators, and prognosticators, who have collectively priced in 10 out of the last 2 actual recessions, are now scrambling to reprice reality. Black gold is plus 4% this morning as I record this. Now, oil's rally isn't just about energy. Make no mistake about it. It's a signal, and you know what to do. And if you don't, consider buying the majors, particularly those with a global footprint and an ultra strong true shareholder yield, TSY for short. Now, if you know how to find companies like the ones I'm describing, excellent. Most investors don't. It'll do you a whole lot of good, you and your portfolio, really, if you stick with them over time. Now, if you'd like some help, you might enjoy reading One Bar Ahead, where my favorite choice has a TSY of 8.06%. As I record this, nearly double the listed 4.63% commonly displayed on many websites. And finally, number 5 today, Tesla hit a 52-week low of 167.41, and critics insisted that it was done for. Doge would kill it. Elon's gone nuts. Competition is coming. Valuations. The brand is done, and so on. I told you point blank. It was a screaming buy and would likely return to $300 within the year. Now, I hope you paid attention and, more importantly, snapped up at least a few shares. Today, Tesla's trading at $317.44 as I record this. And the anti-Elon club, at all costs, is quick to point out, yeah, but Tesla is still down 35.41% from a 52-week high of $488.54 per share set on 18 December 2024. And you know what? That's absolutely true. But the mind blower is this. The world's most successful investors focus continually on being profitable, whereas the wannabes focus on being right. And there's a big difference. You're not here for the dental plan. Pros know that it's possible to make money in both directions, up and down, and that being right is often gravy. So to be clear, there is nothing wrong with not investing in a company like Tesla because you don't like the CEO or you can't deal with his behavior. I get it. Now, for some folks, that's Musk. And again, there's nothing wrong with that. For me, it's El Zucco, and it has been for a long time. The key and the thing you want to think about is coming to terms with the fact that you could miss out on a lot of money and learning to celebrate all of those who have a different viewpoint from your own. Today's bottom line, if I've said it once, I'll say it again. History shows very, very clearly that being invested in markets that may not be perfect beats the cost of waiting to invest in perfect markets. As always, let's make it a great day and start the week strong. You got this, I promise, and I'll see you tomorrow. Thanks for spending a few minutes of your valuable day with me today. See ya.